Welcome back. We are now busy with Unit 4, Financing of Retirement Funds. This is part of our Class of Business, Class 4 series that we are busy with. In this unit, we will look at several ways a retirement fund could be structured for an employer. This unit will also look at the different ways of funding methods within each fund, as well as the role of the employer in managing the fund. In most cases, the design of a new fund for an employer hinges on the expectations of both the employer and the employee. The employer is most concerned about the cost of the fund or his ongoing financial commitment and the time a fund might take away from his business. The employer's decision regarding ownership of the fund is looked at in terms of advantages and disadvantages of private funds and umbrella funds. The employee, on the other hand, is concerned with the end benefit the fund would provide for him and his family. If we look at a practical example, the decision to implement a retirement fund is one of the employer has to make. The employer decides the type and structure of the fund, and in the beginning, the benefits that the fund will provide members. Only once the rules of the fund are registered do the trustees assume control over the fund management. The basic types of retirement funds, we've discussed previously the pension fund, provident fund, retirement annuity fund. But let's have a look at the types of retirement funds. You get the defined contribution fund, and then you get a defined benefit fund. Now, these are two ways of financing a retirement fund, irrespective of whether the fund is a pension and or a provident fund. A defined contribution fund, in a defined contribution fund, the contribution rates required by the employer and the employee are defined in the rules, usually as a percentage of pensionable salary. In the defined benefit fund, a defined benefit fund is a fund where a formula defines the benefits in the fund rules. On retirement, the rules then set out a formula for calculating a member's pension, which then considers the member's salary prior to retirement and his years of fund service. For example, 2% of final salary times the years of service. That will then determine the person's money that he will get from the pension fund. The defined benefit fund the defined contribution fund has become more popular because the risk is less on the employer and it lies within the fund, where the defined benefit fund has become more of a risk for the employer. Right, let's have a look at the differences between the two, the defined contribution fund and the defined benefit fund, as far as retirement benefits is concerned. The defined contribution fund, roll up of accumulated contributions plus growth in the fund, whereas the defined benefit fund is a percentage of final salary based on years of service. So the longer you're in service and the higher your final salary is, the better you'll be, in a better position you'll be as far as pension is concerned. What is the risk for the employer? In the defined contribution fund, the member carries the investment risk. So you can see, as I said earlier, the defined contribution fund has got less risk for the employer, whereas the defined benefit fund is very risky for the employers, as shortfalls in the fund must be then added and contributed by the employer. Administrative costs, it's cheaper to run a defined contribution fund, where a defined benefit fund, the actuarial requirements make administration expensive. Variations or increase in salaries can have a profound effect on the fund and the final value in the fund. Suitability for the employer, for small and medium-sized companies, the defined contribution fund works well, whereas for a medium to large companies, the defined benefit fund would work. Advantages to the members and the fairness of it. the defined contribution fund, it favors younger members or entrants. Younger members have more time to accumulate contributions. It is fairer. Uh, the members get what they pay for. So you get your money paid in plus the return on that investment. Where the defined benefit fund favors older members or entrants, because older members have a shorter period during which they can accumulate contributions. Right, the cost of starting up, the initial outlay is small in the defined contribution fund, where the defined benefit requires a large initial investment outlay. So the strength of the fund, it is not dependent on the ages and the salaries of members. That's the defined contribution fund, where the defined benefit fund, the financial strength of the fund depends heavily on the ages and the salaries of the members. Early retirement penalties, there's no penalties on your defined contribution fund, but normally there's a reduction in benefit for each year by which the early retirement is before the normal retirement date in the defined benefit fund. If we look at advantages, the employer's contributions are limited to an affordable level, whereas in the defined benefit fund, the advantages, the retirement benefits are guaranteed as a percentage of final salary. What is the disadvantages of a contribution fund? It's if there's poor investment returns, it may lower the employee's retirement benefit, whereas the defined benefit fund is open-ended contribution becomes the liability of the employer. So you would see that the defined benefit fund is a more risky fund as far as it is for the employer side. The different types of funds are considered. We look at the tax application and the retirement benefit. Now, once the employer has chosen the funding method applicable to the new fund, a decision must be reached on the fund structure. In this scenario, the employer has two options: pension and or a provident fund. There are only two differences between a pension and a provident fund. Benefits at retirement, as we have discussed earlier, on the retirement from a provident fund, a member may access his full accumulated value in the fund in cash. By contrast, in a retirement fund from a pension fund, the member may only access a maximum of 1/3 of his full accumulated value in cash, and the balance of 2/3 must be used to purchase an annuity or compulsory annuity. The tax treatment of member contributions. Member contributions to a retirement fund are taxable up to a maximum of 27.5 and or 350,000 per annum of the member's salary. Now, this is similar for both provident and a pension fund, as we've also seen earlier. If we look at the tax on income benefits, a pension fund is fully taxable. On provident funds, the income benefit provided for in terms of the rules will be fully taxable. Income benefits purchased with a lump sum, net of tax paid from the fund, will only be taxed on the interest element thereof. So that falls under a different dispensation because it is a purchase that is done by the member out of his free will. It wasn't a compulsory purchase. Right, the tax-free portion of lump sum retirement benefits, the way in which lump sum benefits from pension funds, pension preservation funds, provident preservation funds, and retirement annuities or retirement funds are taxed, changed from the 1st of October 2007. So there's the first 500,000 at this stage is tax-free, assuming that no prior withdrawals was made from the fund. The tax deductibility of employer contributions. Now, this has also been brought in line when the changes were made. The employer may deduct unlimited contribution to the employee's pension fund. The contributions made by the employer will however be taxed as a fringe benefit in the hands of the employee. Tax deductibility of employee contributions. The employee may deduct the contributions to their pension fund up to 27.5% of the taxable income or gross remuneration, whichever is the higher for tax. The 27.5% limit applies to the aggregate of the contributions to all the funds, the pension, provident, and retirement annuity fund. There will be an overall tax deductible limit of 350,000 per annum. The 350 cap includes the cost of any risk cover attached to the fund, and the contributions over the annual limits may be rolled over for the future years, but will be subject to limits applicable in those years. Now, I'm not going to cover the provident fund side because it's exactly the same as we have just discussed. The employer's decision regarding ownership of the fund is examined regarding the advantages and disadvantages of private funds and umbrella funds. Now, privately administrated funds, an employer sets up a pension or provident fund for the employees only. Board of trustees made up of people from a particular employer manages the fund. In a privately administered fund, members of the fund have the opportunity to elect half of the board of the trustees. As in an umbrella fund is not a different type of fund as defined in the Income Tax Act. There are, however, some unique features associated with the umbrella fund that will therefore be discussed for the sake of completeness. An umbrella pension or provident fund is a single occupational fund which is usually established by a life insurer or retirement fund administrator. And employer or a group of employees can apply as participating employers, to a umbrella fund. Right, if you look at umbrella funds versus a private fund, we look at the sponsor for umbrella fund is the product supplier or the administrator, where for the private fund it is the employer itself. Management of the fund, the board of external professional trustees usually appointed by the sponsor. No member trustee requirements, but usually has independent trustees to introduce the integrity. A number of independent trustees depend on the product supplier. The private fund is a board of trustees, 50% elected by members, 50% appointed by the employer. Right, as far as the employer involvement, depends on the umbrella fund structure. It's more commercial. Umbrella funds cater for a management committee, a joint forum to make benefits investment selections for the sub-funds. Within a private fund, the board of trustees make the decision. Rules of the structure, general rules of the product, and special rules of each participating employer. Whereas in a private fund, there's only one set of rules, and that's the rules that the employer put in place. Flexibility of choosing underlying service partners. In an umbrella fund, it depends on the umbrella fund that was chosen. Some limits this flexibility and others allow total freedom of choice of investment managers and insurers. Where in a private fund, there is total flexibility. If we look at the umbrella fund as far as flexibility of negotiating for services, it's limited to application form. Some providers are more flexible to negotiate the services. In the private fund, there's total flexibility of negotiation with service providers on services they should include in the rates. Total flexibility to unpack services. In other words, they have different providers performing different services. As far as benefit options, the umbrella fund is determined by the fund's general rules. Flexibility will be different per provider because you've got various providers inside an umbrella fund. Where a private fund, the universe of benefit options is available to the trustees. Investment philosophy of an umbrella fund is determined by the fund's general rules. Flexibility is different per provider. Where the philosophy of a private fund, a universe of options available to the trustees. The investment manager or multi-managers, In the umbrella fund, determined by the fund's general rules, flexibility will be different per provider. With a private fund, there's a universe of options available to trustees. Right, if we look at the theory and we put it a bit into practice, the employer will need to weigh up the flexibility provided by having their own privately administrated fund against the cost savings achieved by participating in an umbrella fund. Generally, umbrella funds are attractive to smaller employees who realistically cannot afford the cost associated with running a private fund. Private funds are appealing to employers who would like to retain total control over their funds and have very specific or unusual benefits or service providers they would like to include in their fund. Right, occupational retirement funds. Occupational retirement funds are set up by the employers and are usually financed by setting aside the contributions received each month to finance the build-up of members' accumulated credits. The main reasons for separating the fund assets from the employer's business is to ensure that these assets will be available to pay members' benefits, whether or not the employer stays in business. This separation of funds, assets, and the employer's company financial resources is of paramount importance for the security of the members' benefits. Funding of pension entitlements as they build up also help to spread the cost of providing pensions over the working life of the fund members. A contributory versus a non-contributory funds. A fund is normally classified as contributory when the employer and the members share the direct financing of the fund. Contributions by the members are made by way of regular deductions from the earnings. The fund is classified as non-contributory when the employer fully bears the finance of the fund. In other words, the employee does not contribute to the fund itself. One of the key duties of trustees is to ensure that the contributions due to the fund are paid to and received by the fund in good time as prescribed by law. The benefits of members are a direct result of the prudent investment of these contributions. Any delays in remitting deductions made from members' salaries constitute fraud, as members lose out on the interest that would have been received on such contributions. Trustees, therefore, should be vigilant of this and protect your members' interests. Additional and voluntary contributions. Occupational retirement funds may also allow fund members to increase their pension benefits by making additional voluntary contributions or AVCs, either as a fixed rand amount or as a percentage of their salary bill. The AVCs can also be once off or ongoing or as specified in the rules of the fund. The AVCs usually operate on a defined contribution basis, which means that the extra benefits payable will depend on the overall amount of the contributions paid, the returns from the investment of these contributions, and normally, if a pension must be secured, annuity rates prevailing at the time of retirement. All right, what is the advantages of AVCs? These are the following. Take advantage of increased tax benefits for the benefit. By increasing contributions to the retirement fund, the member can increase monthly tax deductibility and effectively pay less tax. Contributions to approved retirement funds are deductible, as we have discussed earlier, to 27.5% of your annual taxable income or remuneration, whichever is the higher figure, but it's capped at 350,000 per annum. The more you put in, the more you save from a tax point while putting more towards your retirement. The cost efficiency. Setting up a separate fund or investment that makes additional savings will, on its own, attract administrative fees and possibly broker or platform fees. However, AVCs into an existing fund won't cost you more, as fees are already set up, usually as a percentage of salary bill or per the member per month, and the costs are already covered. The additional amount will not attract any additional fee. Discipline, because this is a payroll based deduction, there is more discipline with this saving. Also, members cannot access it easily as with other investments, as it is tied with the rest of your retirement benefits. Flexibility, members can decide the amount of ABCs they can make into the fund depending on affordability, and in some cases, maybe as low as 100 Rand, which outside of the fund may be below the limit accepted for a standalone investment. Protection from creditors. All pension and provident fund benefits are protected from creditors. Creditors do not have access to the funds in a retirement fund, thereby protecting your retirement saving from debt collectors. Members' ABCs will thus be protected, unlike any other savings vehicle. Funds operating costs, trustees, traveling, training, conference, etc., fidelity insurance, fund communication, printing, newsletters, benefit statements, and FSCA annual fees. The fund administrative costs, that would be administrative fees, consulting, legal, actuarial services fees, and auditor fees. The fund investment costs, that would be asset manager fees, investment consulting and bank charges. And then the risk benefit costs, there will be cost for the group life, the disability, or for any funeral benefits that's added to the plan. The following are pricing methods used to charge for the various costs. The percentage of payroll, usually applied to administration fees and risk benefits. A percentage of fund assets, usually used by the investment manager or the investment consultants. A fixed rate fee per member per month, usually used by umbrella funds and funeral benefits. And then a rand amount. Services like auditing usually take into account memberships or assets. This concludes our session on financing of retirement funds. The next session will be Unit 5. We will look at management of retirement funds. Thank you for attending this session. I'll see you then in the next one.